Hello again, and thank you for having joined our Hightower Signature Wealth Fireside Chat. My name is Matthias Kuhlmey, and I'm the Chief Development Officer of Hightower. And as before, I'm joined by our brilliant Stephanie Link, Hightower's Chief Investment Strategist and Head of Investment Solutions. Let me start with a quick review. Last month, the two of us discussed how resiliency had become the defining characteristic of both the economy and financial markets. And today, as we usually like to do, we are taking this conversation one step further. I joked last time we keep showing up here, Stephanie, so we need to keep it interesting.
Of course.
So, how about we care less about the headlines and the noise, but instead are focused on asking always different questions to begin with? And, Stephanie, in this spirit, let me kick us off. Markets have been largely stable despite that persistent skepticism that we see. Where do you think investor sentiment sits today?
And it's great to see you, Matthias. That's always one of my favorite webinars to do with
Oh,
you.
thank you. Thank you.
You ask the best questions and always the most challenging. And the first one, I was thinking about it, and I think the investment community, number one, is confused. It's a
Mm,
confusing time with all the negative headlines that are out there, especially with the war, but also on inflation and the Fed and the unknowns. And I think you have a daily trading action that's very confusing. One day, within technology, semiconductors rally. At the same time, software gets killed. The next day, software rallies and semiconductors get killed. And I think it's wearing everyone down, which is why it's really going to be interesting to see during earnings season, which we're currently in, just to listen to what the companies have to say. The biggest comment that was quite confusing was from IBM. IBM said that their customers were switching their spending needs more towards memory, servers, and storage, and less from mainframes and internal software. And that just lit a fire under the semiconductor sectors going higher and memory companies going higher. And yet then the software companies got hit. They could easily be a one-off, but that's the biggest question mark. And I think that's the biggest confusion right now, that particular sector, because I don't think the confusion is in what the economy is doing. The economy has been very strong. You say resilient, I say resilient. We got to find a new word for that term.
yes.
But it has been resilient. And at the same time, the market has been pretty resilient with the S&P 500 up 10% year to date. But I think there's so many things underneath the surface that people were not expecting. For example, the Russell 1000 Growth Index is down 2.24% year to date, and the Russell 1000 Value Index is up 1%. That doesn't sound like a lot, but people were not positioned for value outperforming growth. And I think a lot of people and investors were or are in growth because that has worked over the last 3.5 years, more than that, but especially over the last 3.5, 4 years. And so I say it's okay to be confused, but I also think I worry when people don't worry. I worry when I don't worry, right? Because that means you're complacent, and then you're set up for pullbacks because something out of the blue comes out and the market does go down because no one was really on guard, if you will. And I think you always want to have a little bit on guard, even if you're a long-term investor.
So, Stephanie brings me to an interesting follow-up question or follow-on. You said investors are confused. I wouldn't disagree. It has been, I call it the noise, right? The noise is building, things shift, there's increased volatility in some of the names and some of the segments of the market. So, does this healthy dose of skepticism or confusion actually extend the bull market? What do you think?
I think that it could. I think the most important thing, and you know this better than I do, is the direction of earnings. We talk about stocks follow profits on the way up and on the way down, and we've been very fortunate over the last 3 years to have had better than expected profits and profit growth and earnings revisions. and on the upside. And that's one of the reasons why we've done so well. That's one of the reasons why we're up 10% in the S&P this year, because earnings grew 26% in the first quarter.
Right.
And they're probably going to grow something like 25% in the second quarter. If you exclude some of the big technology players, which will have outsized gains in profits, you're probably looking at 16 to 18%. That's very, very healthy. You and I have been doing this a long time, Matthias. The average growth rate in earnings is 5 to 7%. So a
Yes.
lot of it is driven by the AI and the food chain that we've talked about endlessly, meaning a lot of different sectors are benefiting from all of this AI CapEx spend, and that's benefiting the economy. But it's also because the consumer has also continued to consume, and
Right.
that's also a positive as well. So I think it's not just like lack of confidence or confusion that that would lead to a higher market. It has to be fundamentals eventually.
I was actually going to ask you, you read my mind, Stephanie. In our attempt, I promise, to retire the word resilience, I was thinking to myself, so Stephanie, confusion, resilience aside, what is driving future returns? What comes next?
Well, I think it's really important to focus on where we're growing in the economy, what sectors are doing well, and that it's going to feed into better than expected earnings. It's one of the reasons why I am so big on thematic investing, because I don't necessarily want to just own an ETF based on the themes that I like. I can find stocks that can benefit from a lot of the themes that I like, but it's important to have themes for the long term that have longevity, that have total addressable markets that are large. And it's not just a 1 year trend. I'm talking 5, 10, maybe even 15 years of growth and visible growth. And we've talked about, again, it's the AI food chain, but it's also cybersecurity. It's also robotics. There's a lot of different themes out there that I think are maybe some of them have been exploited, certainly in the semiconductor world, certainly in the industrial world, and even in the cyber world. But I think some other parts of the markets and some other themes, they haven't been as much. So I think it's a real challenging time, Matthias, where you have to, for me, I think long term, I think themes, then I find stocks, and I've got to stick with my conviction. And they may not be the most popular stocks. Or maybe you get opportunities in the most popular stocks because everyone is selling them because they made money in them and they're going elsewhere.
That's right. And just on this note, or a housekeeping note, last month we discussed a full series of your themes for the long-term investor. It was really, really interesting. You had introduced these themes at one of our advisor summits for Hightower. So to our viewers, you can go back. There's a recording of last month. I think we have it on YouTube. It is really interesting. I'm going to stay topically aligned and yet completely away from our usual topics, Stephanie. We see a cooling or even breakdown of trades that were big themes. I'm thinking of digital assets, Bitcoin, precious metals, gold miners. My question, Stephanie, have the fundamental ideas changed? For example, emerging stores of value, or do we see the end of speculation in select assets? What's going on here?
I think so. I think precious metals are different than Bitcoin. Let me tackle gold. I think what happened last year with gold was that you had a lot of uncertainty. Remember, we had the tariffs, and we had the unknowns with what that was going to mean for inflation and for the economy. And I think you had global central bankers change their allocations a little bit. I think they
I
sold
see.
some of our fixed income instruments. I think they also bought more gold as a hedge, and you had nice returns in gold. Of course, now this year it's giving it all back, and that's because I think we have realized and figured out that the tariffs are going away. I mean, we have new tariffs that are coming on, but it's not going to be
That's right.
nearly as onerous. So there's that. There's economy that has been, again, resilient, and it's hung in there in the face of all this unknowns. So you don't necessarily have to hedge. But I think that a lot of the movement in gold last year was that. And I think silver followed. Silver is a little bit different only because half of it is industrial, as you and I've talked about many times. And so that to me was always the better buy on the dip versus gold. I've honestly never made money in gold. The Gen Zs out there are interested very much so in investing in Bitcoin and in crypto, so much so that they'd rather own that asset class more than they'd own equities, which I think is completely wrong. But that being said, I'm looking at what I see and what I'm experiencing with my Gen Z, and it is still a very popular asset class to be in. I think Bitcoin and crypto is a risk on asset, and I think it's getting caught up with the software concerns. Has nothing to do with AI taking over Bitcoin. That is not it. I think there's a high correlation to Bitcoin and crypto with software, especially non-profitable software companies. And I think that's what's getting wrapped up this year and unwound. I think it's overdone completely, but maybe I thought it was overdone on the upside as well. So it's a very volatile asset class because not enough people own it, not enough people understand it. And so, as we get more and more ETFs, I think that will actually, and more interest, I think you will have more, less volatility. But I don't think the story is over. I can just try to rationalize why I think the action is what they are. Obviously you're definitely not the expert on crypto, but I do think it's nice diversification. And I'm talking a very small piece of an overall portfolio.
Yeah, completely agreed. And you name it, there's significant volatility. There is seemingly a younger generation. You sort of labeled the Gen Z. I always considered it the money revolution. This
Yeah.
is a new instrument. This is a potential store of value driven by a group of investors that may not feel they're part of something that is more the traditional sense. You gave me the right lead in for my next question. You talked about ETFs. I was surprised last week's headline was that the ETF industry has now reached a record of 23 trillion globally. That's a
Wow.
really big number.
Huge.
But listening to you, Stephanie, the biggest implication of everything we have discussed is that investors may need to focus less on themes or the broad exposure through ETFs, but more on individual companies. So the question for you, Stephanie, are company fundamentals becoming more important than sector narratives?
I think it's a combination, Matthias. I think you can own some ETFs for diversification and less volatility. Um, you can own broad-based ETFs like the S&P 500, but then again, you can own the cybersecurity ETF. All the other themes that we have out there have ETFs attached to them. But if you really want to create alpha over the longer period of time, you also want to have some active management in there, and you want to have active positions based on the themes. So I think it's a combination. As an active manager, I'm hopeful that it becomes more of a stock picker's market because that's what I love to do and I enjoy it. And it's not been easy over the last several years. All you had to do is really own Mag 7 and call it a day.
Yes.
To me, that's not healthy, number one. And also, to me, as a fundamental analyst and portfolio manager, I grew up believing that valuations matter and less crowded positions tend to work better than crowded positions. I've never really made money being on one side of the boat, as you've heard me say. I don't need to be by myself on the other side of the boat, but somewhere in the middle. And that's why I tend to look for growth at a reasonable price and maybe not the most popular names, names that are kind of on the off the radar screen. But it remains to be seen because the last couple of years it was Mag 7. Mag 7 haven't really done much in the last year, but on the flip side, you've had this craze happening and everyone's crowding into the technology side of things in terms of semiconductors. And that worries me a little bit in the short term.
I could not agree more. You said something I would like to pick up on. Valuations matter. So some of the world's most valuable companies today, Stephanie, they are not even publicly traded. And
Mm.
then we have companies like SpaceX, OpenAI, and others, and they are attracting extraordinary valuations, even long before they ever reach the public markets.
Mm-hmm.
Stephanie, are these valuations justified by a new era of innovation, or are investors once again getting ahead of fundamentals? What do you think?
I think a little bit of the latter, Matthias. I wouldn't want to see several kinds of SpaceX, Anthropic, OpenAI. Like, I wouldn't want to see a lot of companies coming to the market without profits. That being said, I think you can own one or two of these kinds of companies for fun, having fun with it. I mean, using the Peter Lynch method, invest in what you see, in what you know, in what you experience. And I firmly believe in that. And I think out of all the names I just mentioned, I mean, I do think SpaceX is a fascinating story with an amazing leadership team, not just Elon Musk. He's brilliant. We all know that, but it's an entire effort from the whole team. And I
Yes.
think you talk about total addressable markets, they tell you it's their total addressable market is 28.2 or 28.5 trillion dollars. I don't know, but even if it's a quarter of that, there's many ways that they can win, and that's the way I'm viewing it. Yes, it's expensive, and yes, it doesn't have profits. I own like two names in my portfolio that are like that, but it's fun to be part of it. It's exciting. We all see what Starlink is doing, and we're just beginning there. We understand, in terms of the space part of it, we haven't even scratched the surface. And of course, now they're renting out compute, and that could be a
Yeah.
$60 billion business a year. So those, like, I have to make sure I feel like there is growth there so that I'm willing to wait for the profits, but I would not want to see so many of them in come into the and go and become, IPOs. And I certainly wouldn't do it in my portfolio. I want to sleep at night, and I don't think you can if
Yeah.
you don't have profits. And I would say this, momentum is great on the way up. But on the way down, it's impossible to figure out where the bottom is. And I've learned that the hard way over my career. So that's why I am very measured in terms of the amount of companies that I want to try to be involved with on this based on this theme. And I do think if we have a lot of these companies coming out, that's when then I'll worry. That'll be a big worry point for sure.
Then you cannot sleep. We don't want this. Let's stay on the momentum theme and the US markets, or that success story. US markets, when we look back, have consistently outperformed much of the rest of the world.
Yeah.
But critically, valuations outside the US remain very attractive. In fact, looking at emerging markets now, they appear rather inexpensive. And then we have also to consider we had a significant decline of the US dollar that has recovered. So is this a good time, giving these two drivers, to take another look overseas?
I think you can definitely have exposure overseas. Me personally, I wouldn't recommend more than 10%. I still think the US, we have the best companies, we have the best balance sheets, we have the most transparency, most communication skills from our leaders at these big, wonderful companies. Sure, the valuations are more rich. The US is always more rich for everything that I just mentioned. I would be careful with Europe. Europe is up 9% year to date, and they are raising rates. I would be careful with Japan because it's also up quite a bit and they're raising rates. And it's not a bad thing to raise rates. I mean, obviously they're trying to cool down the inflation or cool down the growth. It's not a bad thing to do that, but it's always a challenge to own equities when rates are going higher. And so those are two markets that did very well last year. They're doing fine this year. And I would say I would avoid them. I think Europe always looks cheap because their
Hmm.
margins are so depressed, but they have so many reforms and regulations that their companies are kind of they're held back by doing massive reorganizations like the US companies can to adapt to change. So I'd be careful on Europe. I would wait more for a pullback in Japan. They're seeing very good economic momentum. And I'm glad that they're raising rates to be more normal because it wasn't normal for 20 years. But I think you can wait for a pullback. My favorite has been Brazil. I'm still very convicted in Brazil.
Yes.
It's up 15% on the year, but the demographics are enormous, 714 million people. The average median age is 35. They've got fiscal and monetary policies that are favorable, meaning they're lowering interest rates. They're still high, but they're lowering interest rates. And I think that the economy, while it is very focused on agriculture, it also is focused on fintech and also on power. And we need a lot of power in this world to support all this AI infrastructure. And so I think that that's interesting. One country that I've been wrong on, that I've liked, I'm wrong on India. And I'm not sure why, to be honest with you, because they do have the population growth and they do have fiscal and monetary policies that have been put in place that are very attractive. And they're going to spend 1.7 trillion between now and 2030 on infrastructure. So I'm not sure why you wouldn't want to own that kind of combination. And I think it's a bargain here. One I would not chase would be the Kospi. As we know that the Korean markets, I mean, up 61% year to date. It's really that's really momentum at its finest, and I'm not playing that game.
We talked about it, the sleepless nights. We don't need this. And on Brazil, Stephanie, I couldn't agree more. In my world, Brazil was always the powerhouse of commodities. When we look at the richness of this country, it is incredible. And given sort of where the world stands today, probably a really good opportunity to continue to look at this. We talked about asking the right questions, Stephanie, when I came in. So we have also discussed where investors are looking. Where are they not looking? What is completely sort of out of our sight? Where do we see an opportunity?
I'm going to tell you. So I think the two areas that are maybe the known, but maybe not talked about as much. And I mentioned robotics earlier. I believe we're in the first inning in robotics. We're in the second inning in cybersecurity. We're in the third inning in AI. But robotics, we're in the first inning, and we haven't even scratched the surface with 4 million robots in the world, and that going to grow to 155 million robots by 2050. That's an enormous growth rate, and the more AI gets put into robots and more technology advances into robots, the more companies are going to get more productive, and we're going to solve some of the problems that we have in labor shortages in terms of demographics, retirement. These are in jobs that are kind of repeatable jobs that are very easy for robots to take off. I will point out again, I think I said this last last month on the call, or one of the last months. If you haven't read Andy Jassy's letter, the CEO of Amazon, he sends out a shareholder letter once a year, and he talks all about the need for not only AI and the spend that's going on, but also the powerfulness of robots and how that's totally changing the shape and the trajectory of growth at this company and the productivity. And that's super important. I would say I'm very much positive on women's health. That's another one that I don't think gets enough credit.
Yeah.
Women are half the global population, and yet only 6% of the healthcare funding. From 2020 to 2024, $175 billion was invested across private healthcare, and only $23 billion was directed at women's health. I think as the U.S. closes the gap with healthcare and focusing on women, it could unlock something like $100 billion annually in the United States. And so anything that's tied to menopause or osteoporosis or Alzheimer's or those kinds of innovations, it's going to be really important. And I think there's a lot of very unique companies that are out there, both private and public, by the way, Matthias.
That's really interesting. I had not followed that in detail. Stephanie, I always ask these questions. We have laughed about it. I always ask it differently to sneak up on you. What changes the investment playbook So, what could alter today's investment landscape where you would be concerned or seek opportunities?
So to me, it's all about the economy, Matthias. If we see a massive slowdown, my whole story of earnings goes to, to poop.
That's right.
And the economy, I don't see it, but I am watching energy prices again, as we all are, because we know that
Yes.
we have seen escalation again. I do think it's interesting, even with the recent rally in oil, crude prices are still down 25% from their highs. So that's okay. But I would not want it to continue to creep up higher because that really throws a monkey wrench into what the Fed could do. See, I don't think the Fed is going to do anything this year. I don't think they're going to cut, but I don't think they're going to raise. And I felt very good about that call when we got the recent CPI and PPI numbers. And we had at that point seen crude fall 40%. We also saw some home disinflation as well and productivity. And so I felt like last month we saw the peak of inflation. I can't say that right now because we're looking at the price of crude. And yes, we will have productivities to offset it. It's not going to be a one-for-one thing. And then therefore I worry about if we do see higher inflation, does the Fed then have to start raising rates? And what did we talk about before? When the Fed raises rates, that's always a headwind for equities. And then the last one I would say is if we have any change to the downside in AI CapEx, that's going to be problematic. I don't think that's the case. In fact, we're going to spend 800 billion this year. I think we're going to grow to something like 1.5 trillion next year in CapEx spend, just in listening to what the technology companies have to say. But if there's any change there, that is problematic. Less so for the companies that are putting up this CapEx, more so for the industrial companies that are building out the data centers, the grid manufacturers that are repairing it, and the power companies. I think that is something that I'm watching very, very closely. I don't feel nervous about it right now, but that's something that would change in a pretty big way.
What a gift basket of great ideas and great conversation paired with your so careful risk assessment. Stephanie, thank you as always. And thank you to all of our clients and friends that dialed in today, so to speak. My name is Matthias Kuhlmey with Hightower Signature Wealth, signing off for today until next time for a fresh and interesting update. Thank you.
Thank you.